Well, Trump said it out loud last week when he refused to sign the housing bill. He said, and I'm quoting directly here, it's all about the interest rate. Lower the interest rates and you can have all the housing that you want. It's great housing. This housing's so good. And honestly, he's not wrong about that part. So today, we're going to do exactly what he suggested. We're going to look at what actually happens to the Las Vegas real estate market if rates drop to 5.5%. What does it do to your purchasing power? What does it do to home prices here? What does it do to inventory? And most importantly, what does it mean for you if you're thinking about buying, selling, or investing in Southern Nevada right now? I'm Jacob Ballew, Las Vegas luxury real estate agent at jacobnballew.com. I specialize in the move-up market and luxury markets across Summerlin, Henderson, McDonald Highlands, and the surrounding submarkets. So let's get into these numbers. First, let's establish where we are right now so that you have a good baseline. As of June 2026, the 30-year fixed rate in Nevada is sitting in the mid to upper 6% range. Freddie Mac has it around 6.48 to 6.94% depending on the week and the lender. The median single-family home price in the Vegas metro is anywhere from $465,000 to $490,000 depending on the data source that you're using, with some tracking a modest year-over-year gain of around 4 to 6%. Inventory's climbed significantly from where it was a year ago. We're sitting at roughly 8,000 active listings in the valley, which has shifted us into a more balanced market, leaning slightly toward buyers in many of these price ranges. So let's run the actual math on what a drop to 5.5% does. On a $500,000 purchase with 20% down, you're financing $400,000. At today's rate of roughly 6.75%, your principal and interest payment on that loan is $2,594 a month. At 5.5%, that same $400,000 loan drops to $2,271 a month. So that difference of $323 every single month over a year, that's $3,876 back in your pocket. Over the life of the loan, that gap is $116,000 plus. But here's the more important numbers for the buyer who are on the fence. That $323 a month savings doesn't just lower your payment, it expands what you can qualify for. So if a lender qualifies you based on a maximum monthly payment of $2,594 and your rate drops from 6.75 to 5.5, you can now borrow $456,000 instead of $400,000 at that exact same monthly payment. So that is $56,000 of additional purchasing power without changing anything about your income or your down payment. In Las Vegas terms, that is the difference between shopping at $625,000 and shopping at $570,000. And that gap opens up entirely different neighborhoods, entirely different finishes, and entirely different floor plans. So let's talk about what a move like that does to the broader Las Vegas market. The first thing that happens when rates drop meaningfully is that demand accelerates. There are thousands of buyers sitting on the sidelines right now who are qualified, but they're not comfortable with their payment at the current rate. So a move to 5.5% does not just activate some of those buyers, it activates a lot of them, and it activates them fast. So when demand increases and the inventory is not caught up yet, prices are going to follow. We saw exactly that dynamic play out after every significant rate drop in recent memory. The second thing that happens is that the rate lock-in effect starts to loosen. Right now, a significant number of existing homeowners are sitting on mortgages in the 3 to 4% range from 2020, 2021. And they don't want to sell because trading a 3.5% rate for 6.75% rate on their next purchase it's a brutal hit. But at 5.5%, that gap starts to feel a little more manageable. So some of those sellers come off the sidelines. That adds supply, which creates more options for buyers and helps put a ceiling on how fast these prices can run. So lower rates do two things simultaneously. They bring buyers in and they bring sellers in. The net effect on prices depend on which side responds faster. So in Las Vegas specifically, the rate lock-in effect has been a real constraint. We've seen inventory build from around 5,200 listings in early 25 to about 8,100 today. But a meaningful chunk of that increase came from new construction and from sellers who simply had to move due to life circumstances. A genuine rate drop to 5.5 would accelerate both sides of that equation more aggressively. Now here's the part that most people don't think about when they imagine a rate drop. The luxury and the move-up segment responds differently than the entry-level market. So if you're buying a $1.5 million home in the Ridges or McDonald Highlands, you're likely working with a jumbo loan. And the jumbo rates today are running around 6.8 to 7.1, and a drop to 5.5% on a $1.2 million loan is about a $1,500 a month payment difference. At that level, the rate environment is not just a factor, it's often the deciding variable for buyers who are liquid enough to be able to wait. And those buyers come off the fence quick when the math improves. And when they do, they compete hard for a limited pool of high quality homes in the best submarkets. And this is also the investor calculation to think through. At current rates, DSCR investors, the people buying rental properties based on the property's income, not their personal income, are running tight margins on single family rentals in Vegas. So a rate drop to 5.5% changes that math meaningfully. So more deals pencil out. More out-of-state investors start targeting Vegas. Nevada's zero state income tax and our rental demand fundamentals make Vegas a natural landing spot for that capital when that rate environment allows. So what is the realistic path to 5.5%? Here's the honest answer. We're not here yet, and the current Federal Reserve projection does not take us there by the year end. The Fed is signaling roughly 2 quarter-point cuts over the remainder of 2026, which most analysts say get the 30-year mortgage rate to 6.4% range, not 5.5%. To get to 5.5, you would need either significantly faster Fed cuts driven by a cooling economy, a meaningful drop in inflation that lets the bond yields come down, or some combination of those forces happening faster than current projections suggest. It is possible, but it's not imminent. But here's what matters for how you should be thinking about this right now. You do not have to wait for 5.5% to benefit from improving rates. We've already seen movement from the 7+% range down toward the mid-6s over the past year. Every quarter point improvement in your rate changes your payment and your qualifications. And there is a strategy tool available right now that a lot of buyers are sleeping on, and that's builder rate buydowns. Builders in master plan communities like Summerlin, Sky Canyon, and Cadence are currently offering permanent rate buydowns that in some cases get buyers into the 4 to 5% range on new construction. So that's not a teaser rate, that's a permanent buydown that the builder is funding out of their margin to move the inventory. So if you're a buyer who's been sitting on the sidelines waiting for the rates to fall, that tool is available to you right now in several Las Vegas submarkets, and you don't have to wait for the Fed to do anything. The bottom line is this: a drop to 5.5% would be transformative for this market. It would unlock purchasing power. It would pull sellers off the sidelines and likely push prices upward in the most desirable Vegas submarkets, particularly at the move up and the luxury level. So if you're waiting to buy, the risk that you're taking is that by the time rates fall where you do feel comfortable, prices have moved up enough to absorb much of that savings. And that is the trade-off that every buyer that's sitting on the sidelines is making right now. Whether they realize it or not, if you wait to sit down and run your specific numbers, what your payment looks like today versus what it looks like at different rate scenarios and what that means for your purchasing power in these submarkets that you're targeting, that is exactly what I do. So please reach out to me at my website, jacobandballew.com, and let's build your strategy before the market shifts. If this hopefully gave you some useful context, hit the subscribe button so you can catch up with the next update. I'm tracking this rate environment closely because it is the single biggest variable affecting buyers and sellers in this market right now. I'll see you guys in the next one.